Hey, good evening, everybody. My name is Brad Hesselberg. I run the Market Forge. And before we get started, I do want to make it clear I am a licensed financial advisor, but this is not advice. This is simply analysis about market structure, liquidity, and risk. I'm not doing any buy and sells or anything like that. We are going to look at some charts, but nothing in here is advice. If you are looking for a financial advisor, you can click the link below under the Market Forge Insider and read about what we do. And if that's something of interest to you, feel free to check that out. But I'm simply doing this to create a helpful structure, help you understand how I'm looking at things currently to get some idea of what's going on. This is simply analysis. But if you do find this helpful, please consider subscribing and clicking the like button. It definitely helps to support the channel. But each week, right now, we're looking at the question of, is the market stable? Is it strained? Is it breaking? What can we see when we look at different charts and different information? See if we can put together a story and help us understand what's going on in here. Context is always important. When you have knowledge, when you have context, the probability of success goes up. It's never a guarantee, but you want the probabilities higher, and that means that more of your ideas will be on the right side of it, hopefully. So here we're going to just kick things off. We're going to keep it really straightforward. What we're looking at here is the S&P on the daily. We're not looking at small time frames. We want to look at things, sort of more intermediate and into the future, not real short-term frames. So the daily is a good way for us to get a general idea of what we're looking at. So this is just the S&P 500. A lot of you are probably very familiar with this. The top 500 stocks, large U.S. stocks. And if you know a little bit about markets, it's the general S&P is not equally rated. So it's going to be more heavily weighted towards the higher performing stocks, the mega caps, things like that. But what something I'm going to point out as we're going through here is that we might be seeing a bit of change of the guard, so to speak. But if you look at the S&P, I mean, it looks healthy. It looks like it's in a good place. It just wants to continue to break highs. We're getting higher lows and, higher highs here. So we just keep trending up, right? So it looks healthy. But what I want to touch on is actually our equally weighted S&P. So this means that every stock held in this one is equally weighted. It's not heavier on the top like with your Nvidias and Microsofts and Googles and those things. Each stock has an equal weighting in the overall return. And what we see is that we have the same pattern where you're actually getting higher low, higher high. Now, why is that important? Now, what we're seeing is it's performing alongside of the traditional S&P, the one that's not equally weighted. Why is that important? Well, if it's performing similarly to what we see in the S&P 500, that might mean that more stocks are getting involved in the overall move to the upside, instead of, the Mag 7 carrying most of the weight, which is what we've seen for a couple of years now. To further emphasize that, we take a look at the S&P 600. So what is the S&P 600? A lot of people aren't really familiar with the S&P 600. This is S&P focused on small caps. This is 600 of the strongest, healthiest U.S. small cap stocks. So why do we look at this? Well, if small caps seem to be outperforming large caps, that could mean that investors are comfortable taking on a bit more risk. Now they do this because potentially liquidity is expanding. We're going into more of an easing cycle where interest rates are down, money is cheaper. Therefore, it's cheaper to get your hands on money. and use it to build businesses. Typically, you see small caps do well in high liquidity type environments. So what is this suggesting? First, I want to point out that S&P 600 has not broken its recent all-time high. The last time it hit an all-time high was November 2004 or 2024. November, end of November 2024. So we've been trying to get back to all-time highs for over a year now, right? And now we're starting to see those opportunities potentially come back on the table. So what do we recognize about this? Well, what jumps out to me is this nice kind of cup-shaped pattern. It's not a perfect cup, but you get the idea. You know, it comes all the way down and makes its way back up, creating sort of a jagged cup look. But what's important is that it's coming back to all-time highs. Okay, that shows us participation in the market. When you look at charts, you're looking at emotions. People are feeling risk on. They're feeling like investing. They're feeling like pushing these charts to the upside. Okay, so I think that's really important to point out. The last one I wanted to cover, not the last one I wanted to cover, but relative to these indexes, is the QQQs. This is basically the NASDAQ. What I think is really interesting here is that you've got, it's not a strong one, but you do have a bit of a downtrend here. You are setting in lower highs. I mean, these ones, you could call them equal, but they still haven't come back to all-time highs. And at least for the last, 1, 2, 3, 4, 5 retest, that has not wanted to come back into this pocket, right? This is based off previous sell-off, previous liquidity. No one wanted to buy at these prices. They sold off. And at least for the time being, this tells me that tech is not as involved in this push to the upside on the S&P 500. That's important because tech, the Mag 7, they've really driven this market up until this point. But now, that's not the case. Okay, that's not the case based off of what we're looking at. It's other sectors getting involved, which expands what we call breadth, which means that there's more stocks that are involved pushing up the overall S&P 500 instead of just the tech stocks. That's relevant. Breadth is important. If you have a lot of stocks participating in market growth, it tends to be seen as we'll say, healthier market. It doesn't mean it's healthy, but those are some signs that we look for when analyzing that part. So the next thing I want to bring up is kind of our volatility check, right? We're going to take a look at the overall volatility index. So this tells you overall volatility in the market. Now, volatility is not bad. A lot of times volatility is perceived as bad. Volatility can swing to both the upside and the downside. That's the way that it works. If you got volatility to the upside, prices appreciate quickly. Usually that's, a bullish market. Might be kind of dangerous depending on what you're holding on to, but nonetheless, volatility works both ways. Okay? So it doesn't mean if you have a high volatility market, it's not necessarily a bad thing. But what we see here is volatility is trending down. When we do get spikes, they're pretty short-lived. So we get these quick pops of a few days, and then it comes right back down. We had this little pocket here from October 25th to Friday, November 21st. So we had this little pocket here, but aside from that, you're seeing mostly downside, right? What does that mean? Well, that means that you're not getting large spikes of price to the upside or to the downside. means it's just sort of steady eddy, if you will. It doesn't necessarily tell you directional if it's steady eddy to the downside or to the upside, but it simply means that is how the market is moving overall. So I think it's important to hit context on that. But the more important one that I'm looking at is going to be it's called your MOVE index. Now, this is the bond market option volatility index. So what this tells us is bond volatility. Okay. So this is also currently, very obviously moving to the downside. Okay. But when we look at this, what this screams to me currently is this feels a bit controlled. I mean, these short ups and downs to the downside feels like maybe we have some intervention going on. And we're going to support that here with a couple other slides that we're going to pull up. Now, we're going to leave trading view. Now we want to go to, this is the Federal Reserve website, basically. So this is where we come for general data about, overall liquidity, total assets owned by the Fed, spikes in Fed buying, and house affordability. That's what we're going to be looking at tonight. But there's a lot of other charts that you can look at. So this is the total assets at the Fed. All right. So if we look here time-wise, okay, what I like to do is go back to 2020. Why do I want to look at 2020? Well, 2020 is when we had the COVID event, and they pumped a bunch of money into the system, right? We had assets flying after we had that V-shaped recovery coming out of the bottom of COVID. And what you see here is the Fed really aggressively adding to their balance sheet, which means they're buying more assets. They're putting money into the system. A lot of times they're just buying debt, but they're putting cash into the system by buying assets, right? So typically in those types of situations, you call it quantitative easing. Basically, the Fed's getting involved because the market is having some sort of an issue. In this case, it was COVID, but it changes as, depending on the situation. Now, what you'll see here is that around 2022, it peaked. Now, why is that? Well, that's because the Fed started quantitative tightening, where they do the opposite. They're going to sell those bonds and they're going to hoard cash. They're not going to put more cash into the system. Okay. Why is this relevant? Well, it's relevant because typically when the Fed is putting money into the system, risk assets tend to perform well. Things like the S&P, things like NASDAQ, and even small caps, right? Things that have a bit more volatility, have a bit more upside, have a higher risk profile. Those tend to perform better in what you refer to as like a high liquidity event or type market. And then what we see from there is basically just straight downside. So that means they're just pulling cash out of the system, and it's becoming more and more difficult for banks to lend. It's more and more difficult for businesses to get their hands on money. It's more difficult for consumers to get their hands on additional debt outside of credit cards and things. But what you notice, and we're going to look at this a lot closer, but what you can see basically starting the beginning of December, which that's when they announced that they were going to end quantitative tightening, you see a slight uptick in the Fed's balance sheet. Now, we don't want to assume anything right away, right? Thinking, oh, here it comes. Fed's going to start putting money into the system and asset prices are going to go up. Because you do look back on March 8th, 2023, you had this slight spike, and then we came right back down. Could we see that again? Of course, we totally could. But it's important to identify these things. Now, I want to point out a couple of things that I think are relevant when I look at these. So the next thing I want to look at is here's actually, you can see the increases in the Fed essentially buying assets. Okay. So like we pointed out before, 2022 was when they started quantitative tightening, or when you're really starting to see it aggressively here, in terms of the changing in asset buying. So from here, it's just everything stays below this black line. Why is that? Because they're tightening. They're not buying assets. They're selling assets. They continue to sell their balance sheet. So we did point out in 2023, it was May, or no, 20, yep, it was 2023. I think it was March 1st, 2023. You saw a spike. Go back and look at that again. It was, oh, never mind. It was, yep, March 8th, 2023. Okay, we saw this spike, which means that they were buying assets again. Okay, March 2023, and the reason it's gonna make sense why I point this out in a second. So at that time, you had this massive spike down under the black line. It got back to the black line, tried to come above a little bit, and then sold off again. Okay, the difference here is that we're above the black line when they're starting to add to their balance sheet. I think that's important context. Now that we're above the black line, if we continue to hold above the black line, that would tend to suggest that that's what we're looking for. We're looking for more of a risk-on environment, more assets getting involved in the overall market tends to mean it's a healthier market. Does it mean green light go? Of course not. You have to take everything into context, and it all depends on who you are, what your expectations are. But again, these are important things to understand when we're looking at overall markets. So I know that there is sort of interest in, or an increase in, what is being referred to as sort of gamification. I've heard it called a lot of different things, but this is, it basically is people feeling like they can't get ahead, like the American dream has died. Their cost of living continues to climb, but how much they make does not. And a lot of reason for that is the cost, the affordability of housing. So what this chart tells us is, and this only goes back a year, this is a relatively new chart in context to the site. There's another one that's older, but it's not updated to this point. So we're just going to take a look at this one. So house affordability is really high. Basically means that it's based off how much people make. It's very difficult to buy a home because interest rates are very high. Housing prices are very high. So people feel checked out. They feel like it's just impossible for them to get by. You hear stories of people, they're really good at keeping a balance sheet at home. They're really good at managing their checking. They're really good at just maintaining everything, and they're still struggling to get by. Maybe some of them are working 2 jobs. That's real. And this chart helps really show that that's really is what we're looking at. And why you've seen the gamification of investing, especially in, younger people, for sure. They feel like they have to take more risk in order to get the returns so that they can put themselves and their family in a better place. So that is absolutely real. But with that said, there is a way to invest, make good money, and managing risk, which is actually something I cover in the free PDF download that I've got in the description below. I'll put that down there in case anybody's interested in. All right. So what I want to jump to next is I want to look at the overall Bitcoin chart, right? This this, in my opinion, is a really good gauge as far as how does liquidity really look? What's everybody's risk appetite? Because Bitcoin is considered, crypto is considered more of a higher risk asset, tends to perform well in more liquidity, higher risk environments. So what I want to do here is I want to show the actual M2 global money supply. Now, what stands out clearly to me is that this continues to go higher, but Bitcoin has not done that. You've seen an aggressive sell-off in Bitcoin here, while M2 money supply continues to grind higher. What does that say? Well, it says a few things. Is that Bitcoin is currently not staying with the overall money supply. Historically, it followed it relatively close. It lagged in some cases, but if you go back, when the money supply has been flat, Bitcoin's flat. I mean, there's definitely some similarities here. There's this huge span where it's flat. That's going to be kind of correlate with here because it lags. Correlates with this time. But then as you see it goes up, it goes up. M2 money supply continues. BTC sells off. So that suggests a few things. Could be one, that Bitcoin's is no longer following M2 money supply, which is certainly possible. It doesn't always have to correlate. It could suggest that Bitcoin really is the canary in the coal mine, and it's showing us that as interest wanes on this, could we actually see the money supply come down? Absolutely. That could certainly tell us that. Or, you could just be looking at a really aggressive Bitcoin catch-up scenario. Those are all, potential options as to what's going on here. With that said, with it's it really is tough to gauge exactly what this is. So this is something that I'm watching, but it's something to keep a close eye on from that perspective. It's anything. Yeah, I'll just leave it at that. So the other thing that I wanted to touch on is our high yield corporate bonds chart. Now, why am I looking at high yield corporate bonds? Well, so the reason I'm doing that is I want to see how healthy the bond market is. Now, why do we want to see how healthy the bond market is? Because the stock market can be manipulated. It's harder to do that in the bond market. The bond market is going to be part of your truth teller, right? If we see Bitcoin as a potential canary in the coal mine, it's going to give us some insight as to what is potentially down the road. You can do something similar with the bond market. So what we're looking at here is actually the high yield corporate bonds. Okay. As long as this continues to rise to the upside, or at least trade sideways, which is pretty much what we've got here. See, you've got a pretty healthy range for the most part. As long as it stays within this range or continues to the upside, it means that people are willing to take a little bit more risk when it comes to bonds and chase that higher yield. That tells us that it's a healthy and or controlled bond market. Because what you actually have here is a spike in liquidity to the upside. Okay? That means that the bond markets could be controlled to some extent by this surplus in cash flow when they're buying assets and putting cash into the market. Why? Because they're buying debt. They're buying debt. This is debt. Okay? Most of it's not necessarily going to be corporate debt, but basically the what it is if this continues to go higher, it tends to show a relatively healthy bond market because people are willing to take a bit more risk. And what you have here, this is the treasury bond market. Okay, this is government bonds. Now we want this to stay lower. So as long as it stays within this range, give or take, okay, we're not going to be ultra hyper specific about it, just general range. As long as it stays below this line, continues to trend down or trade sideways, plumbing looks okay, right? They're clearly getting involved in the plumbing. That's why you see this spike in asset purchases, but that's not necessarily a bad thing. It means that they're managing the market. Okay, it's not unusual to see that. Now, if this continues to spike and continues to spike higher and they're buying more and more assets, that's something we have to keep an eye on. Specifically, these two charts are high yield. If this comes up and then we start to aggressively sell below this yellow line, stress is on the table in the bond market. Inverse here. If we come in, break up higher, that's showing us that there's stress in the market. And that's something we have to be wary of. As soon as we see that stress, that is the signal that this is not as healthy as it appears. That's when we have to start watching these closer and looking for this trend to shift from higher highs to lower highs. Okay, but we're not seeing that right now. So as of now, you have a relatively balanced, although it looks like, liquidity is certainly being added, but as of right now, it looks like a relatively healthy market. Credit has stability, move is in a downtrend, our bonds are where they need to be. It's not cracking. It looks relatively stable at the moment. So that's my framework. That's what I'm looking at. Okay, this is not a forecast. I don't have a crystal ball, but these are the things that I'm going to be looking at going into the next week is how do these hold up? Do they stay around where they are? And that will help me give me context as the year continues to roll on. So this is my plan. I'm going to do these every week, same process, same discipline. And if you found this useful, I do have some links in the description below that you can take a look at. I do direct one-on-one financial advice, and I have a PDF that helps develop that framework. But if you found it useful, subscribe, give me a like. But thanks for watching the show, and have a great time.